Welcome back. This is Mark, and we're moving forward in becoming early adopters of Bitcurrency with this fourth class, P for Practice, in our free course to help you quickly become an early adopter ahead of everyone else, ahead of the masses. If you haven't already, take a moment now to share, like, and hit subscribe. And thanks for joining the Early Adopter Bitcurrency team and leaving your comments below. We appreciate it. In review, we've said enough to the value-leaking idea of fiat currency that steals wealth from each of us. We accept that the banking and monetary system is dysfunctional and broken beyond repair and in need of a replacement system built for the people from the ground up. We've decided to become acquainted with Bitcurrency, a digital trust machine that solves the problem of money empty of value and being diluted into worthlessness beyond our control. I think of Bitcurrency not so much as a revolution, but as a substitution, replacing the lifeless and weak with good, strong, sound money, replacing physical markers with digital tokens that live online, allowing each of us to transact money directly, like email, at any time, to anyone, in any amount, for no fees. In Class 3, we took an exciting, empowering step, owning, setting up an exchange account, a personal wallet, and holding Bitcurrency. Now, today in Class 4 Practice, we'll deepen our understanding of how Bitcurrency works and ways that we need to be responsible stewards of our own Bitcurrency, the value of our work, our labor, and our time. We'll cover 4 key points: tiers and keys, sloshing and muting, long-term holding, and avoiding scams. And above all, we'll learn to respect Bitcurrency as the people's money, your money, my money, our money. So first, tiers. We're trading off accessibility and security. Last class we learned that wallets hold Bitcurrency and that they're programs that live on your computer. I suggested that the versatile Exodus wallet was a great starting point. Inside Exodus is an access pass, a kind of ignition key or start button to move Bitcurrency out of your wallet, and it's known as a private key. Because it is a long bunch of gibberish-looking digits and letters, it would be difficult to remember or type, so we let wallets act as our servants, handling our private keys in the background for us. The wallet securely stores our digital private key, and we just tell the wallet what we want to do, how much to send, and to where. So each wallet has this internal hidden secure private key, which is controlled by you, the owner, through your wallet and your password. But it also has a visible public key, and that's the address where we can tell others to send us Bitcurrency. It acts as a kind of a business card so people know how to reach us to send us money. Anyone and everyone can see your public key, which is also a bunch of gibberishy numbers and letters. It's public. It's out in the open. And the worst thing that could happen if someone had your public address is that they could use it inadvertently and send you money, which arguably probably wouldn't be so terrible. Your private keys, however, live in your wallet buried deep inside for the wallet software to use when you log in and want to send money. So the wallet on your computer, which you control with a password, is under your control, and it's as safe as your computer is safe. You have a wallet also on an exchange when you make a purchase of Bitcurrency or sell some of it to convert into fiat currency. But unfortunately, you don't have the private key to that wallet. The exchange does. So like in the past with fiat currency, we end up in this trust relationship with the exchange for a short period of time. I like to think of the exchange as an on-ramp or off-ramp between Bitcurrency and fiat currency. And these wallets on the exchange are kind of like short-term loading docks or staging areas for your Bitcurrency. We don't mind giving our money, for example, to a retail store clerk in passing in exchange for a shirt or a pair of shoes. But it's unlikely that we'd want to have a random store clerk hold our whole paycheck for the week until the next time we decided to buy. Wallets on an exchange are similar. If you want to buy Bitcurrency, it'll be deposited in your exchange wallet. If you want to sell Bitcurrency for fiat currency, you'll transfer it from your private wallet on your computer to your exchange wallet online in order to do the sale. So in the process of bridging between Bitcurrency and fiat currency, We temporarily tolerate the third-party exchange for the transaction. It's kind of a necessary evil, a troll under the bridge, as I've described before. But the important point here is to keep your money under your control in your home private wallet and get it off the exchange once they've fulfilled the transaction of buying or selling. And the reason is simple. You don't have control of the private keys for your exchange wallet. The exchange does. So it comes down to answering a simple question. If you had $100, would you feel better if a stranger were holding it or if you were holding it? Exchanges are certainly mostly trustworthy, but life can get complicated, and when exchanges get busy or audited or have computer problems or power shutdowns is probably when you would want access to your BitCurrency the most. Bottom line, be responsible and transfer your money to your personal wallet. So there's a third tier. Just like in real life, which this is, you probably have your currency money in different places. Even with our fiat currency, we have holders for our money that trade two things: easy access versus high security. As an example, you might keep a small amount of money in your pocket or in a checking account for everyday expenses. But you and I don't walk around with our retirement 401k or a whole IRA in our wallet. A second point is that socking money away out of our sight and easy reach can help us resist the urge to spend it and also to encourage savings. Similarly with BitCurrency, I think of there being three bins or tiers. One, a small amount for money in use, which might still be in an exchange wallet or a local wallet. A second, under your control in a local wallet on your computer. And a third, held offline in a cold storage device. So let's define that. Hot and cold in the computer world refer to whether the wallet is on or off the internet. Clearly, if a wallet device is disconnected from the internet, such as on a USB special hardware wallet that we'll discuss in a minute, it can't be accessed or hacked by bad guys. They just can't see it if it's not on the internet. So this is the safe or safe deposit box idea for storing long-term BitCurrency value that you're holding for the future. You actually might physically place this device in a safe or somewhere safe, although we do discourage using a bank safe deposit box, since these have been known to get compromised or made inaccessible in times of financial crisis, again, when you most want to get your hands on your own money. So these Tier 3 hardware wallets are offline, which we called earlier cold storage for keeping BitCurrency. Not only do we control the hardware keys, we can keep the small physical USB device that holds our BitCurrency value offline away from hackers. The current popular brands are KeepKey, Trezor, and Ledger Nano. And again, these are USB devices that plug into your computer to temporarily go online, transfer BitCurrency in or out, and then disconnect for safe storage. Currently, they cost about $100. The Lonely Adopters Club and sloshing. Lonely and thick-skinned. As early adopters, we're using BitCurrency, a new technology, before most people have even heard of it or are using it. And that can make it kind of a lonely place, being in the minority, but in the smart minority. You and I are in the right place. We have amazing timing, but we're going to have to put up with a little loneliness. And that's why we have an Adopt team to share your experience with. So leave comments here, join us on Facebook and Twitter. We're kind of an adoption support group for early adopters. I remember learning about the internet in the mid-90s, and I wanted to tell everyone. I wanted to shake them about how this would change the world. But for the most part, they hadn't even heard of it, and they could not care less about my ranting. In my office, I got set up for email, but the big problem at the time was finding someone to send email to. In retrospect, I was dead on with my excitement, just a few years ahead of the momentum and rush. And we're kind of in the same place now with BitCurrency. Many hundreds of companies are working on exciting, life-changing projects using Bitcoin, Litecoin, Ethereum, and many others, and there are hundreds of millions of startup dollars in place. But we're not quite at the place where you can easily buy a coffee with Litecoin. And that's okay. Just 18 months ago, something as easy to use as the Exodus wallet didn't exist. The take-home message here is because our timing is so good, and because we are early adopters, the whole Bitcurrency world is still small, which makes it perfect timing, but the space has a lot of catching up to do to merge its potential with actual reality. And that means that every little bit of news or new large investor that comes in has an effect on the market. They say that the Bitcurrency world is volatile, meaning that it doesn't just sit in one place value-wise all day long. Here's a perspective picture. The world currency value is, for example's sake, about $200 trillion. That means that a few $billion with a B of action by one person or country doesn't really have much effect on the market. It's only 1/1000% of the whole. I kind of picture this like a grown-up jumping into the ocean to go swimming. The ocean barely notices. Bitcurrency in mid-2018 is just about a $500 billion market altogether, and Bitcoin is about half of that. So this means that all of Bitcurrency is like an ever-expanding wading pool. Get that same grown-up jumping in the pool, and there's a good deal of splashing. In the world of Bitcurrency, one of my mentors, Cliff High, sometimes calls that splashing sloshing. Every time anyone does or says anything, there's a ripple or wave in the price. Compared to 2 years ago when the Bitcurrency total was only 10 billion, things have really stabilized as the pool gets 40 times larger. It used to be that there were price swings of 100%, and now we're just seeing 10% or 20%. I expect by the end of the year, as the Bitcurrency value goes up over $1 trillion and the pool triples in size again, the waves will become smaller still. I'm telling you this for a few reasons. Expect a strong general upward trend in Bitcurrency value, but expect lots of short-term swings. Both of these facts are a signal to you that you're positioned in the right place at the right time. If there was no splash when a fat man did a cannonball into the wading pool, we'd be pretty surprised. And press mute. On a daily or weekly basis, the newsmakers around you who love sensationalism, that's their business, will feast on the normal sloshing that you and I have come to accept as healthy growth. You'll read about amazing price swings, rising like a rocket, and a few days later, headlines that proclaim the death of Bitcoin. Tune it out. Ignore it. Small pools get splashy. I'm not encouraging you to practice owning and using Bitcurrency to be a day trader, following it every hour. You need to trust in the force, in the long run, in the inherent stable stoic values of a decentralized peer-to-peer digital money system as contrasted with our current currency and banking system, which is filled with inflation, corruption, and greed, parachuting down. Famous personalities from established financial institutions will be interviewed and tell you that Bitcurrency is a bubble or a scam. Actually, the central bank idea is more akin to a Ponzi scheme than Bitcurrency, but that certainly won't be in the news. You maybe weren't paying attention in 1994 when TV anchors called the internet the same list of names, or the announcement in 2008, right before the mortgage implosion, that reassured us that the economy was in a happy place. They don't know. They're just making news. This Internet of Money transition is going to be an even dirtier fight than in 2000, though, because banks have a lot more to lose than just the demise of vinyl records or newspapers or travel agencies. So again, expect name-calling. Sit back, get popcorn, and ignore it. There's a great quote from philosopher Arthur Schopenhauer who said, "All truth passes through 3 stages. First, it is ridiculed. Second, it is violently opposed. Third, it is accepted as being self-evident." Change doesn't come easily, ever. And banks and politicians will dig in and fight for monetary power and control if it's threatened, and it is being threatened. Here's a thought. If a 5-year-old on a tricycle came up to you and pointed a plastic squirt gun at you, you wouldn't call 911. Why? Because it's non-threatening. If Bitcurrency was a stupid, pointless idea, No one would care or rant or oppose it or comment. They would just humor it as childish and walk away. But because it is as powerful an idea to money as the internet was to information, established businesses and companies are done ignoring and ridiculing it, which they did for the first half dozen years, as Bitcurrency rose in value from 0 to 400 billion. Now they're at a different stage. They're angry, they're thrashing, and they're violently opposing it because it is real and viable. Philosopher Cliff High described the internet as software eating information. I like that. And I think with Bitcurrency, we are early adopters in this new process of software eating money. The louder that people yell on TV and in the media, the stronger the evidence that Bitcurrency is gaining momentum and absolutely, positively not going away. Noise validates. Remember that. This Adopt session, Practice, Class 4, has been split into 2 parts. This is the end of Part 1. I'll see you soon in Part 2.